Thanks everybody for coming in. This is Northeastern Blockchain Club and Coinmetrics. We have Tim here, who's the CEO of Coinmetrics, as well as some of the research team. So I'll let you guys take it away. Thanks again for coming in. I know we're super excited. So
cool. Pleasure to be here. Nice to meet everybody. I think the format was, I'll tell you a little bit about probably me, Coinmetrics. And then I've got some slides on kind of broadly what we do and how we get kind of deeply into the data science end of the blockchain side of things. But at a high level, we'll get rid of that. At a high level, so I've spent 3.5 decades building data companies for traditional capital markets. This is the 5th data company that I've built. Those companies are usually involved in some new asset class that's evolving into the marketplace. So a long time ago, did a lot in fixed income. I was involved in credit default swaps in the early 2000s as that was coming out, and started into blockchain in 2016, focusing on it as a technology structure rather than a cryptographic asset play at that point, because I primarily thought that this was an interesting technology to study more broadly on a broad set of use cases. But formally around Coinmetrics, it actually started as an open source project in 2016. My co-founder, or what I call the original founder of Coinmetrics, is a young guy by the name of Nick Carter. I don't know if any of you follow Nick on Twitter or anywhere else. He's got quite a big personality when it comes to Bitcoin in the crypto world. But what Nick was doing for his master's thesis was he wanted to study the economic activities of public blockchains. And so these are open permissionless blockchains where in fact you can see all of the base data that any of these blockchains generate. And you can do interesting things to study the underlying economic value of these various blockchains. So Nick and I got together in 2018. I'd been working at a company called Consensus, which was one of the Ethereum co-founders, was building an Ethereum development shop to kind of study various crypto economic activities and token issuance. But along the way, I was always kind of talking to my clients from before about what they thought about the asset class, what they thought about the data structures. And what I kept hearing is that we need a data set that allows us to understand how to participate or how to invest in the asset class. And so what we end up needing to do is, what we need to do is we need to join together. I don't know how to get rid of that for us. It's up there. Yeah. There we go. I get some of the tech, most of it I get. So basically what we set out to do is bring together all of the underlying information that you needed to be able to study this asset class. And so you need network data, which is the on-chain side of the data set, market data indexes, and then we do a lot of work in risk management. Reasonably interesting along the way, this is actually the first venture-backed company that I've been a part of. The other businesses were either part of big companies. They were all part of big companies at the end, or I sold into the big companies that we kind of self-funded. And I'm happy, if you're interested later, the venture process, which some of you might be involved in or whatever, is kind of an interesting experience at this point. For our seed round in 2018, one of our early investors was Nick had a venture fund that he left from Fidelity and started. So it's called Castle Island Ventures. Nick Carter and Matt Walsh here in Boston, we're the lead investor in the seed round. But all along the way, we knew we needed to kind of convince some legacy financial institutions that this was interesting. So Fidelity has been an investor in Coinmetrics since the seed round of funding. They're also one of our bigger clients. Just on that kind of journey. So then we did a Series B round about a year later. So we did 1.9 million in that seed round. We did 6 million in 2019 that we then focused on a couple of different components for investors. We wanted crypto native investors. So Coinbase is an investor in the company, DCG, Digital Currency Group. And then there's a couple of other traditional venture capital funds that came in. So as you're kind of rolling out your capital funding, you're kind of thinking, what strategic partners do you want to bring along with you? So in the first round, we anchored with Fidelity as a traditional finance. This round, we wanted to go a little more crypto native to kind of get our feeling around that. And then we finished a Series B round for $15 million in April. That round was led by Goldman Sachs. And so what we're doing along the way, not only building value as a business, but we're building value with our investors. We're thinking, pragmatically about who's going to do best to accelerate us past some of our competition that are being funded away, how are we running the business. And so Goldman led the Series B round. And then hopefully we don't get too far down the alphabet before we get to profitability. But in general, that's kind of the trajectory of how we've thought about funding the business. So what Nick was doing in 2017 was this open source project, and we continue to kind of open source a lot of our data. So if you go to coinmetrics.io, there's a tremendous amount of free community data aggregated from all of this work we do. That's out there for you all to kind of work with if you want to. We have over 25,000 daily followers or users of that data set. We have some free newsletters that we give away. Because in the crypto ecosystem at this point, it's all about education, right? There's the core crypto native folks who really understand what's going on, and they get off on all kind of different tangents. Metaverse is the theme of this week. I was at the hackathon in Toronto where CryptoKitties, the original NFT, kind of started. We kind of built that as a hackathon one weekend from the consensus team, and look what NFTs have started to become and how that's built out. But all of that information and the way that all this gets founded is on the blockchains, and whether it's through smart contracts or at the protocol level, what you need to do is you need to study that side. And what that represents is the fundamental behavior of the blockchains. How many users are on the blockchain? How many miners are on the blockchain? What's the distribution of that economic activity across those blockchains? So we run in our infrastructure in physical data centers, we run 30 unique blockchain nodes. So we run Bitcoin, Litecoin, Ethereum, blah, 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 blah. Our target customers at this point in our journey are regulated financial institutions. And so we build this a lot like I've built other data companies where we run 3 Bitcoin nodes. We have 2 physical data centers that are live ingesting this data constantly, so that if we have a failure in any one of those data centers, we can roll over to the other one. We're about to launch our 3rd data center. So, between data center and physical infrastructure and engineering talent, that's kind of where most of the capital ends up going when you build kind of these businesses. But they scale quite well because the data source, you source it once and then it's digital data. So you can kind of, resell it across. So 30 plus blockchain nodes, that gives us over 350 assets, because as most of you know, Ethereum generates a lot of assets itself. So you got the layer 2s and the layer 1s. Those nodes that we're running are mostly layer 1 nodes. On the network or the market data side of things, we connect to 30 spot crypto exchanges of the global exchanges out there. Some folks in the space will claim they connect to 300 or 400 or whatever shitcoin exchange they connect to out there. Basically, we kind of focus in on, again, our target market is regulated financial institutions globally. We probably actually only would need 8 exchanges to kind of satisfy the need there, but that'd probably be somewhere near shitty and not with enough to get. So we need more exposure to the lower tail of the assets out there. So we have to connect to 30 exchanges. We connect to 14 derivatives exchanges. Again, same kind of back-end infrastructure and architecture on how we bring the data in and how we collect it. And then we do a couple of other things over here. Indexes, you probably know what indexes are. They're an aggregated view of either a single asset or a stack of assets that would be tradable, and how you look at those. It's an interesting business model from a number of different angles, but you can think of it as a way to sell content and data more or less. So if I have 20 assets in an index that I'm tracking, I want to understand all the behaviors of those 20 assets so I can track the index and make sure that I haven't been able to find some type of arbitrage in that stack. And in crypto, you will definitely find arbitrage in that stack of 20, 10, 5, 1, whatever it is. So that it's an interesting play. And then the risk management side of what we do, because we run all these blockchains and all this infrastructure, we're actually watching every block on every chain develop. The next block is developing. So Bitcoin is a UTXO chain. It in theory develops a new block every 10 minutes. What's going on while that's developing? On one side, there's a game being played by the miners who are trying to solve the hash for the next block to be cured. But underneath that, you're trying to stuff transactions into that block, whether they could be any kind of transaction. Today, the most normal one is basically a financial transaction. I'm trying to get a trade in there. So it's a 1 megabyte block. That's all you can put in there is 1 megabyte full of data. And the miners are on the other side. Not only are they solving the problem to win the reward from the next block, but they're also kind of deciding whether or not they're going to process your transaction. Have you put enough fees in your transaction in order for them to include you? So there's a stack ranking going on in there. I'll put whatever number of Satoshis against this trade that I want to move across. And if there's a bunch of people ahead of me or a bunch of transactions ahead of me that were willing to pay more, I might not make that block because it'll exceed that 1 megabyte level. But the other thing that's going on is the miners could end up working on 2 blocks. One could solve first, and there could be another group of miners who are working on another block at the same time. They haven't yet agreed that these guys have actually won. And so my transactions could actually be in this other block that hasn't been actually processed into the blockchain yet. And what happens there and why you're watching that is that's where a 51% attack symptom can start. So that you've got a group of miners who are basically accumulating hash power, and they want to take control of the chain. So in theory, they could mine that block itself, and they could convince miners from the other side to come over and work with them and fork the chain, which would allow them to take control of the direction of the chain going forward. And so why is a 51% attack important? In Bitcoin, it's a big enough animal right now, over $1 trillion in assets, that you probably wouldn't see an entity trying to attack it, but you could certainly see some type of large sovereign entity or foreign government or somebody trying to hack it. We've seen plenty of issues going on with SWIFT network, which is the big transfer network for payments, where people have gone in and hacked the South Korean address for the SWIFT transfer of payments and taking control of that. So money can buy you a lot of things, and $1 trillion worth of assets is certainly kind of honeypot for that stuff. So we work a lot on the risk management side of the business as well. I think I'm going to be able to skip through a few slides for you. Any questions? Happy to just raise your hand along the way if you'd like to.
Yeah, back what you said about the data center, what made you guys decide to build out your own data center versus using like a cloud provider or something that would be a lower startup cost?
Yeah, actually the other way around. So when we were going through the early phases of Coinmetrics, we kind of stumbled on using physical data centers. And then what it turned out is we weren't going for a B2C play where we were going to have a lot of our customers kind of hitting against the data centers, which is when you would kind of go to the cloud. And we're a huge storage hog. We have a big data set. So what happened there was we had a number of competitors in the early days who were bragging that their AWS bill was $125,000 a month because they were running all this cloud compute. At the same time, our data center bills for much more data than were $8,000 a month. The other thing in the cloud providers is you end up with an egress and an ingress charge, and that's where it gets expensive, is the amount. We had a situation, we were running some stuff on Google's BigQuery this week, and I had a $10,000 bill within 2 days because we were running the wrong analytic program up there. So the cloud providers, what they're doing for most of their folks is they're taking a lot of the people cost out. So I wouldn't need the infrastructure engineers that we have on team and a few other things. But those people who work for us, who are those infrastructure engineers that can do other things while that's running. So it's turned out to be very cost effective for us to do this at this stage. From a philosophical and pragmatic way of looking at it, we believe that there's so much centralization of some of these networks in the cloud providers that isn't kind of known, that there is actually a centralization issue because so many folks are in an AWS cloud in a certain region. And we saw when China took the Asian region off, they took it off through Amazon Cloud. So if we were running our infrastructure, because we do run 3 geolocated, spatially located places, that we could have been deplatformed due to geopolitical risk, whereas in physical data infrastructure, we aren't going to run that risk. So we've got a couple of reasons why that worked out for us. One was just dumb luck initially that we were building there, and it saved us a lot of money. And then as we grew and scaled, it became more apparent that the physical play for us was a better idea. Last thing on that is we're selling to large regulated financial institutions for the, don't want to sound like a broken record. So our next data center is right in the middle of New Jersey with where all of the big banks and others service from. So that'll allow us, while our market data is not yet there for high frequency trading, because you necessarily want to be near an exchange, all of our node operations will be right there. So they'll have proximity to those and will minimize the gap and any delay between what we're running on the node infrastructure and what they're getting from us. I ran a business at Thomson Reuters for a number of years. And one of the data services we provide was the federal unemployment and other announcements. And we literally had gold plugs in the walls in the Fed lockup in order to shorten the time frame between when that news was released in Washington and when it got to our customers. So once you kind of get to that H2F, high frequency trading thing, milliseconds start to count. So a couple of different reasons that we did that.
On that point, you guys host the blockchain node so you can collect data in real time.
Yep.
Is there any edge you have in like faster data collection compared to people? Because otherwise, why wouldn't like Goldman run their own nodes?
Okay, a couple of questions in there that are, so why can't Goldman run their own nodes? Is they're a regulated financial institution? They can't even hold physical Bitcoin. So they have some challenges there. The other thing that is analogous here is if you understood the story of Linux, which was the open source operating system out there, the reason that Red Hat was so successful is that these financial institutions are very risk averse. So they couldn't get a contract for service and support and upgrade of Linux. So Red Hat evolved and was that kind of service gateway. So for any major upgrades of Linux or any other things that happened, these institutions could have a contract with Red Hat that made them comfortable that this was going to get upgraded. We see the same thing playing out in the public blockchains. Goldman can't have a contract with Bitcoin, so they would think that they need to do that. The other part of the question was proximity.
Yeah, I'm saying like speed for getting it from the blockchain.
Yeah. Again, so Bitcoin's a little boring. 10 minutes to 40 minutes is when a block evolves. Getting the speed of information out of that, kind of interesting, but we've got some new things coming on the line now. So Solana is the latest hot thing. It's doing 500,000 transactions per second. That could be something where you're super interested to be really tight to what those transactions are. The other thing that's going on in the Ethereum world is kind of net value, or where basically you're kind of going around the block and going to the miners and convincing them to mine or include your transactions. So that's some areas where you could see some edge coming. Hopefully the industry is smart enough and doesn't keep doing our equivalent of payment for order flow, which is more or less what that is. So on the blockchain side of things, I think as they speed up, proximity will become more of an issue. Right now, it's kind of just a matter of getting the data as quickly as you can for them, but I'm not seeing it necessarily a trading edge for anybody.
Got it. So like no institutionalized like miner extracted value.
No, again, the miner extracted value is a game they're playing right now. When more of the folks who are good at arbitrage are here, they'll go away. I mean, it won't happen because they either won't play with that mining pool or they'll figure out how to be in there first with a lot of money. Yes, sir.
Hey, so first of all, I'm a big fan of Coinmetrics.
Thank you.
I've been following it since Nick Carter posted an article this summer on CoinDesk,
Yeah.
and following a lot of work yours as well. I'm just curious. You mentioned that in the beginning it was open source, and there had to be a massive transformation to commercialize that. Could you just detail that process and if that conflicts with the original value prop of that product?
Yeah, no, good question. So, we've tried to organize the commercial entity around the values of open, and that stands for us for open, pioneering, elucidating, and neutral. And so we're still trying to do as much of that. We kind of back to the Linux Red Hat concept. We knew the commercial side of our business would come from these financial institutions not wanting to do this themselves, and we go through a lot of hoops to be able to do what we're providing for them. We still give away a tremendous amount of community data, and we will always do that. I think some of our blockchain exporters are still free in public source libraries out on the web for people to use. So we intend to continue to do that. We know, over the past 3 years, we've kind of proved our hypothesis that the commercial enterprises are not going to kind of go to a free public blockchain explorer or a free public data website, that they would be willing to kind of interact with somebody like us. So I think we can bridge that gap. And the last thing on that, so, we were really deliberate when we knew when we were going to include Goldman Sachs as an investor this round. We were kind of going right at the community with that one, like, you now have gone to the vampire squid, like, what the fuck, Nick, excuse me. So we were really deliberate about, messaging clearly for our commercial entities that we were doing this, and that helped credentialize us. And we, have kind of continued to work with our open source community. Nick put out a blog post right after that, and we continue, the metrics we release versus what are on our actually paid side of the house are de minimis as far as it goes. They're paying more for knowing that they can come to us and we're going to be reliable and our things are going to be there. So it's an interesting transition. Definitely, it's a really good question, because when you build something open source and then you decide to go over to the dark side, it's definitely an interesting kind of process to manage across the way.
And just like as a follow-up, working with these large institutions, I'm sure they also have their own internal like research department. Do you foresee any clicking issue going forward with trying to keep some data as proprietary and keep Coinmetrics or that not be the case?
So it's so actually they're more concerned that their data is going to have to be resold, and that's happened over decades now, where the Goldman and the big banks are putting out something from their trading desks, and some creative person, like we didn't credit default swaps. That's what we did in early 2000. Credit default swaps, we basically took the prices from all the dealers that they were sending to the buy side and turned those into a data feed for the buy side, and then used that data, and then we sold it back to Goldman Sachs. And the other banks. And so they're slightly kind of on edge about what's going to happen on the crypto side of things. As far as developing proprietary stuff for them, we are not doing that. And so there's a couple of things we've built on the risk side that we've written some patents for, and we've patented that side of things to protect against that. So we've basically got a few things in there where one of the things we were trying to solve for is I have a transaction, or I have an account right now in Bitcoin, for example, and it's just been hacked. And that transaction from the hacker is sitting in this next mempool before the block is cured. We've worked on a way to be able to get into that next block, because we can notify someone in real time that their address has been hacked and outbid the attacker with the miners. So it's not a matter of I've got to go in and bid $6 billion because that's what I've got sitting over in that mempool. I've just got to incentivize the miners at a slightly higher rate to convince them to pay me back, because I've just outbid the attacker. Those kinds of things, and again, this is the fourth business with Goldman involved in it, and you kind of are like, this is, one of the things with this business in particular, given I have a large alliance around crypto in general that we could get into over hours, but I really think it's an enabling, empowering kind of technology that we need to be careful of. And we don't want to give them kind of the arms and the ammunition to go screw with, helping us solve the problems of the unbanked and other things. But they're all things when you start into this, if you kind of, if you look up at me and you're kind of like, okay, this guy just built another data company to go out and make a ton of money, didn't give a shit about the crypto world. I kind of came into it at this point. I didn't need to come into it, but I kind of embrace a lot of the ethos about what the enabling empowerment of this data set or this infrastructure can do for people. And so having worked with these folks before, you get really deliberate about how you interact with them. They do the same thing back to us. The stuff I have to go through for them is ridiculous. Any other questions before? Cool. I kind of walk through this. We run a lot of blockchain infrastructure. We connect from a ton of exchanges. And so we have a massive repository of data, which Kyle, who heads up our research team, and Nate spend, most of their lives going through that, pulling out our weekly State of the Network newsletter. I don't know what the terabyte amount of storage is, but it's ridiculous. We're collecting all that trade data in real time from every exchange. We're collecting full order books from all of the exchanges. And so we now have, tier one hedge funds, not crypto hedge funds, but hedge funds who have processed tons of data before, just dying to get all this data into their systems to figure out what does the order book look like, what's the liquidity profile of the market look like, and how to study all of that stuff. Right now, there's ultimately the alpha for this asset class will come from the on-chain side of the asset class. the problem right now is that, well, it's not a problem. There is so much alpha just on the market data side. The price spreads between, say, Coinbase and Kraken or Coinbase and Bitstamp are enough that the folks who are trading in the market can make plenty of money just on the spreads between moving trades between those two exchanges. Forget about any kind of, global arbitrage you want to do on some, Qcoin in Hong Kong or Singapore versus Coinbase. So there's huge opportunities there. The on-chain side of things, as I said, is where you kind of study the underlying activity of these things. And what I'll try and dive into a little bit for you, if you want to. So this wasn't meant to be a product pitch. It's more about what are we doing on the network side of things in the pro data and how do we see it be used. So, definitely seeing it being used in research, basically in quant discretionary trading, valuation purposes. Like if any of you are into DeFi right now, we're all kind of hooked up on what's total value locked. What is the kind of PE ratio of these various DeFi protocols at this point, and how do we kind of understand that? So, yeah, you can get that rug pulled anytime you want to, or pay it or not. So, that's kind of the really interesting use case for capital markets. We do a lot of reports in the world with various, if you guys know Kathy Wood or don't follow Kathy Wood, I would suggest you do, but I'm not a financial professional, nor is this financial advice. I would stay out of certain ETFs over there, but I think she's certainly an interesting human being and has got some great things going on over there. Again, we do, the vampire squid uses our stuff and does some interesting work with it. God bless him. So, how do we look at this? We look at it in a lot of different ways. So we create an asset taxonomy, right? So you would sit there and say you've got Bitcoin, which we could argue is a store of value coin. We could argue that Ethereum is an application coin, and maybe ETH is the gas to drive level 2 applications. And how do you study that and how do you manage it? So we start by creating a tremendous amount of metrics off of the underlying data. So you probably all know this, but I'll go through it anyhow. Basically, any of these are basically public ledgers, where it's basically debits and credits in and out of the ledger. It's very straightforward. Bitcoin is slightly different than Ethereum because one is an account-based chain, Ethereum, whereas Bitcoin is a UTXO chain, which Kyle can tell you what the difference is later. But we end up having to study all of the underlying activity of what's going on. So some interesting things that we focus on, which is like really nuanced, weird shit. So the free float of Bitcoin right now, or the supply of Bitcoin allegedly released by the chain is somewhere around 18,152,000 something. But the amount that's actually circulating to trade is somewhere closer to 14,000 units, or 14 million units, excuse me. And why is that? Satoshi's wallet has never moved from the day he started. There's a bunch of coins that are lost and unknown. And so how do we know that? We can see the addresses on chain and see that they've never moved, that nothing's moved in or out of any of these addresses over time, or they stopped moving 10 years ago, or we know that they're aggregated to some large exchange or some other place. So the transparency on what you can see on the underlying address just from the public blockchain is fascinating. And it's what makes the data set so interesting to kind of study and follow along with. And kind of back to one of the earlier questions, it's free and available publicly. Like you all are smart enough to go find this data, sort it yourself. You can look at our metrics online. You can take any of this off and do it yourself. What we do is kind of the value added pack it up. So if you're interested in K1s and S1s and Q1s, you can go to the Fed, you can go to the SEC's website and get all that shit too, but have fun organizing it. I mean, we're kind of an organizing entity that creates things and kind of makes it easier for folks to work with. As I mentioned, we kind of start to look at an asset taxonomy. So when you take a data set, I don't know how many of y'all are data scientists versus crypto enthusiasts or whatever, but data science is kind of a fancy way, and I don't want to underestimate because I'm not a data scientist, but I've been in data my whole career. And you have to start with a base level taxonomy of what are you studying, how does it behave, and so we kind of start going through the crypto world with looking at what is it, a privacy coin, is it a stable coin, is it a currency, Is it a commodity backed? You know, how do you start to think about that so you can start to create cohorts with that data as you go through? So now you've got kind of your taxonomy framed out. You can go in and start to study, okay, within that type of chain, what are the behaviors that I can get from that? So I can see the addresses, which I discussed earlier. But then there's a bunch of different metrics we categorize in economic activity, exchanges, where we study the flow in and out of exchange wallets, revenues and fees. So how much did the Bitcoin or Ethereum miners make today? I think we pay a lot of attention since, I'm going to go way out of my speed, EIP 1, what was it? 1551, yeah. You know, the amount of ETH that's been burned as a result of going through that process. We can see what efforts going into the NFT market at this point and how much of that's been expanded on that side of things. So you kind of really get this rich data set that is, you know, we're still in the early days of just organizing this before you really start to kind of think about deploying anything kind of machine learning or AI into it, because we've only been through so many cycles and some of these assets are very new at this point. Some of the insights that we take off of there, which I've kind of highlighted before, this is one that would give you an idea of what's the vibrancy that's going on chain right now. So what are the active addresses in Bitcoin? How many people are participating over time? And you can see how it goes up and down. And if you probably study the up, you can pretty much run that one-to-one with the price of Bitcoin at this point. These are new addresses. So how many new people are participating in the ecosystem is identified by new addresses. And because we're running the chains and we've got an inventory of what addresses have already been there, we can see the new addresses that are coming out. And we can see how big are they coming in? Are they coming in as just, you know, Satoshi size addresses, or how are they coming in? Any of you who follow the space, this is like the classic holder band, which in this one is studying age dispersion rather than necessarily size of wallet, which I find this is age, right?
Yeah, that's right.
So basically what we're doing here in any of the various markets is trying to understand if the holders are still holding long, or we've got loose hands at this point that have come into the market. So what we would have seen last spring or winter when we went up to 64K last time is we can see the pattern of a bunch of people came in January, they didn't hold very long and they left, right? But you'll always see kind of the never moved and the 5-year plus are indicators of how we're building it up. So you can see since 18, those kinds of bigger things are coming in. So you got a lot of long-term holders going in, and then you can kind of study the shorter term traders or kind of the speculators coming in and out of the marketplace. Kyle, you want to do MVRE?
Yeah, sure. Yeah, so this is MVRV. So this is an interesting one. So this compares the just traditional market cap, so market value, just taking every single coin and multiplying it by the current price, and comparing that to the ratio of something called realized value or realized cap. And so realized cap is kind of like, you think of it as a kind of like a cost basis. So you take the last time that the coin moved on chain, each coin moved on chain, and multiply that by the price at that time that moved. So this is a good indicator because it kind of gives a sense of you know, how much like it gives you kind of market tops and bottoms, because as new people come into the market, you know, you get more coins moving, and if a lot of coins are moving, you kind of get that more like speculative behavior. And so this has traditionally been a really good indicator to kind of find market tops. And so like a market value, realized value of 3, for example, has kind of historically indicated market tops, while somewhere below 1 is generally like market capitulation.
Yeah, so again, we've been working on this one for quite a while. It's quite interesting. I think that's February 18th of this year, somewhere around there. It was a Sunday night, went over 3, and you can see it came down. It's kind of back in a very bullish indicator. And now, unlike kind of like market data technicals, this is kind of the actual behavior in the addresses. This is the side of the market that you can't see in traditional trading. I can see basically the volume, and I can, I can look at moving averages on just the stock price of Bitcoin, and you can see how it's dropping. But this is actually comparing, as Kyle said, the underlying value versus the realized value. The reason the realized value would go up is because more people are coming in now at this new price. I would have bought Bitcoin a long time ago, so that Bitcoin that I would have bought would be valued at $1,500. And that's how that would come into that realized value versus if I bought right now, it's 62,000 something. So anyhow, again, these are kind of things that are starting to get observed over time. And then I've challenged folks going, okay, so this is a new indicator here that, we're seeing this, okay. But the last time it did this, it got up here, the price was probably 8,000. Right, so can you take another data set and overlay it and give me a range that we're going to get to here, 85 to 115,000 maybe? But there's interesting ways to kind of look at the data as we're going through things. So it's, again, that's taken, since 2017. So Nick and Antoine Lecavier on my team basically pioneered this idea of realized value or realized cap. And it's become really kind of an interesting concept. This one is kind of free float supply, MVT. So what we're doing here again is kind of taking out things that aren't trading, aren't available in liquid. They're those lost wallets or Satoshi wallets, and kind of taking a look at how this data matures over time. This is one where we're looking at large holders. So addresses with over $1 million in them, right? And so you can see it's going up. The price of Bitcoin is going up. The more, in my view, another interesting side of this is, so it's got a $64,000 price on it right now. So I could still have whatever and get to $1 million from before. You can peel back from this and see the number of actual Bitcoins that are in large holders, right? So you can kind of see the number of native units rather than the dollar overlay to see whether you're really getting more adoption to the asset class, right? So this has got kind of a fake veneer around it of the $61,000 price point in it versus I still hold the 2 Bitcoin I had from 10 years ago. It's now just worth a lot more. And again, we continue to look at large holders. Let me kind of bomb through. This is what we talked about with the free float versus the total supply that's out there. Here we're kind of looking at 1-year active supply versus kind of the closing prices. So you're seeing the movement of the active amount of Bitcoin that's on chain and how that's starting to impact and might potentially impact the price of Bitcoin. Again, velocity, let me bomb through it because I'm kind of hash rate, which is an important point. You can see how hash rate dropped off when the Chinese miners were taken offline, but you can see it came back up. I don't know if that's all in Texas or where the hell it's come back from, but it's starting to come back online. So hash rate is a sign of the security of the network. So it's the amount of computing power that's going in to create the next block. If you start to think about risk from Bitcoin and you see the hash rate go down to these various levels, that's where if you were going to attack, you would try to attack because there isn't that much power behind it. But again, it's kind of come back online. I love Bitcoin. Again, as we see that, let me run through some quick stuff on Ethereum where we start looking at fees. You can see how fees kind of transition over time.
I think we have a question.
Yeah.
Yep.
Are you also like keeping data from like all the layer 2s as far as like Arbitrum and Polygon and all those go?
Yes. Yeah. So stable coins, we're covering stable coins. We probably have, this is kind of stable coin issuance over time and how that's building over the various chains that it's working on. DeFi, here you go. We're kind of following the active address accounts in the various DeFi protocols. See where else we're going. Yeah, but and then again on the market data side. So I thought kind of for this one, the more interesting side of the data play is actually the on-chain side. If you're, and it seems like if you're part of this club, you're probably into the market side of things, but this is basically the primitives of trades, volume, the amount of in the order book, how that works out. it is the place where where all of the hedge funds and large banks are starting, is to focus on the market data side, because it's easy for them to understand. The harder part on the on-chain side of things, they're used to consistent time series data, right? So when we send them a block of Bitcoin data that happened 16 minutes after it was supposed to form, and we're starting to ping them with Ethereum blocks, they don't quite understand how to stack it up yet. So, I always say that when we were providing people with fixed income content, there were books and books written on what you do with the trade bonds, right? You understand what you're looking for. In this marketplace, it's white space for anybody who wants to dive in and understand what's going on the on-chain side of things. We study the futures and the spot volume. I'll stop in a second. So this is one of the more interesting things from what the team had to worry about early on. So we're fortunate that our data is carried on CNBC every 35 seconds or something. If you look on CNBC, you'll see Bitcoin CM with a price. That's our data. Why is that interesting? Primarily because what we're doing is we're taking a bunch of our exchanges in real time and calculating what we see as the actual price if it's the aggregated price of what's just going on in the marketplace. And for this, we spend a lot of time kind of looking at the data. And I won't go into it, but basically for us to calculate this, we're doing a time-weighted, volume-weighted median, and then we're doing an inverse time correlation, which means we're taking the more recent data and using that as a heavier input to come up with the prices. The only reason this chart is really interesting is because this was a major flash crash that was generated by Kraken. God love Jesse. If you trade there, up to you. But what we're trying to do is normalize the market. So if you want that opportunity here, by the way, if you're trading in this marketplace, you clearly want to do something between that difference and that difference. But our job is to kind of provide this stable indication of where the market was, where I probably would have got traded if I would have gone into the marketplace. And that's a situation where our data science team spent a lot of time going through various data sets to understand. In traditional finance, what they usually will use is a time-weighted, volume-weighted average because the data is fairly normal. When you get into more data sets that are abnormal, you'll start to look at things like medians because you want to get rid of that problem at the bottom. If you would have done an average price out of all this and these were large trades, you would have got dragged way down here out of the market, down with all of this stuff, when you could have only got traded at Coinbase up at this level. So, for me, as I said, I'm not a data scientist in general, but the amount of interesting stuff that the teams that work for us do is just huge. And, if you're looking for a data set to have fun with, I would dive the hell into this stuff.
I would definitely agree with that.
Cool. That's kind of it for a formal presentation. I'm, happy to talk about business, crypto, whatever you got questions for. I'll let you get to wherever the hell you wanted to be in rather than here.
So these are basically like the scam wicks, right? They're gonna just go down like super fast. Like this recently happened in finance and their derivatives exchange where people got billed at like $9,000 for Bitcoin or some crazy number like that.
Yeah, exactly. And so what we're using this for is, so if you were borrowing from BlockFi, you would have got called out. Your loan could have got liquidated. You could have got a collateral call if the price would have gone down here. BlockFi is using our kind of smooth rate in their lending platform. So you're not going to get, all the markets would have to go down. It's something that we used to see in data because you can see, so one of the behaviors that is interesting that happens is because we can see these addresses and someone will put Bitcoin into their cold wallet. They'll put it in cold storage, it'll be off chain. We can see where, we can see approximately where it went to an address that it went, but it's cold, it's not moving. We can also see when that address loads up onto the chain to start to do something. So historically, what we've seen, if there's large amounts of Bitcoin being loaded into a hot wallet on an exchange, there's going to be a sell-off shortly after that. So we had one incident a couple of years ago on Saturday night where somebody loaded 2,500 Bitcoin onto Gemini at dinner time, 8 o'clock night on Saturday night, which is a stupid move. But for us, the interesting thing that we can study, because we cover all exchanges, we can see where all the selling pattern happened by exchange afterwards and when it got exhausted because the supply got sucked up. Which if you're going to try and arb the market or trade this market is why you want to get as much granularity in the various exchanges and then see the underlying. The thing that I will say is today's market is completely different. 2,500 Bitcoin going on the chain is not a big deal anymore. And that's, if you weren't paying attention over time, you would make that trade. You would just short as soon as you could or get out of the way or whatever. Now we see that happen and it's like, you know, because there's just there's bigger money in the market now. David, how are you? Nice to see you. Thanks for getting me here.
Yeah, thanks for coming, stopping by. Just had a question, you know, it's like, I feel like the market structure has really evolved these past couple of years. From your point of view, in terms of like connecting with, like trading infrastructure and whatnot, can you just kind of like talk about how that has kind of evolved a little bit? And then also would love to get your thoughts on like the reference rate and how you guys kind of like build those relationships with, you know, with like NBC and whoever to kind of like use your rate and, you know, give like competitors in the space.
Sure. Yeah, so you know, market structure over the past, so this is the third, it's my third anniversary this week running Coinmetrics, which is great to survive a startup company for 3 years and kind of being on the upside of things. But you know, a lot of things have evolved. So qualified custody was the first thing we were worried about resolving, right? So to bring financial institutions in, I do come from a culture of not my keys, not my coins, but you know, we'll accept that somebody needs to hold them for big people. So we see that evolve with the Fidelity, and Bank of New York is coming in. BitGo has some of this stuff. So Coinbase is a qualified custodian. So that's getting the institutions more comfortable with getting on board and coming into the space. Trading infrastructure side of things, Coinbase gobbled up Tagomi. There's a couple of good plays out there. I think where you'll really see the transition is when, because the actual trading of the asset is not a cryptographic effort. It's kind of internalized. So what I mean by that is, if you're going to trade Bitcoin on Coinbase, you're not going on to the blockchain with that trade. And even if you're trading with an OTC desk, so you can really take some legacy stuff and just turn it into, this is the amount of this that I want to trade to you, and maybe I got to extend the number of digits and the rounding errors, but I can still use that infrastructure. And I think we're seeing some, you know, good startups working on the crypto side of that purely. But I think what you'll see is that there's some traditional providers that can just hop on when they need to. CBOE just bought a large crypto or a startup crypto exchange. So we'll see what a big player like that is going to do. And then, you know, I think the last point that you brought up about the reference rates and kind of getting them on CNBC and other things, you know, as I just kind of highlighted, it's because of the way the market trades. So the reason that if you're looking at any kind of market screen, whether it's your own or whether it's one of the TV networks, Bloomberg or whatever, you all know that somebody like IBM only trades on the New York Stock Exchange. So the only place you can care about the price or liquidity is from the New York Stock Exchange. In crypto, you need to go to multiple venues to really understand what you could trade this for, which is why we went to this reference rate kind of thing where we take, for Bitcoin, we take 7 of those exchanges out of the 30 that we have, and we're running a live algorithm constantly that's doing this kind of time-weighted, volume-weighted medium process across those exchanges that gives you that aggregate view. Some would argue, you know, that I should just use my local market price. So if I'm only trading on Coinbase, I should just worry about Coinbase. The reason that, you know, kind of CNBC and others have bought into what we're doing is they get the fact it's an aggregate view. So what that means is it behaves more like a foreign exchange trade, which doesn't sit on a centralized venue. You trade FX over different platforms.
Yeah, that's pretty cool. It's also like, it's fascinating that like, you know, there is no sort of like single point price point of like, this is what like a Bitcoin should be quoted at. It's just like an aggregate, which, yeah, it's like, I don't know, for such a big market, you'd think that they'd figure something out, but at the same time, like, I don't know if they can.
Well, yeah, I mean, and it still happens in other markets, even on, you know, even in the fixed income marketplace right now, the way the trade goes, if I'm trading a corporate bond, is I have a benchmark of the, you know, if I'm trading 10-year paper, or I'm trading the 10-year treasury, where does that price come from? And then I've got a credit spread over the top of it. And so there's some vagaries, which is why bonds are so weird to trade. And then in FX, because of the multi-markets, they'll trade euros to dollars or however they're trading it. So it tends to be why people in FX drive fancier cars. I don't know.
Also, currently it's pretty hard for like institutions to actually engage in DeFi. Like I tried Ethereum the other day to figure out how to bridge L2 and do that. Like what products do you have your eye on for making it accessible for institutions to use DeFi and have that for this?
Yeah, so as I said, the clients that we talk to all day long, it's really weird conversation. So the tier 1 banks and asset managers are afraid of DeFi like they should be. The problem, so what we're trying to do and to enable it more broadly is unpack what's going into that smart contract so we can all understand it. And one of the things we're working on is kind of that asset taxonomy to start with. So what is Uni? Is it just a decentralized exchange? And how should I classify that? If I have a portfolio of holdings, how would I look at Uni as a DeFi protocol? Or if I'm using Compound, which is a lending protocol, so Compound is actually a debt or a lending protocol. How do I think about that? And then within that smart contract, what are the trigger things? Like what's the yield I can get on Compound and how do I make sure I search out for that and how do I get that? So the beautiful thing about the way the business, and it's just dumb shit luck, the way we set it up by running all the on-chain stuff, is we can build to anything. Like we have the best coverage on stable coins than we have from the beginning because we read the on-chain side of things. Kyle and Nate started, we're jamming on NFT stuff. It's all because it's on Ethereum and we can read whatever. So, for us at this point, we're unpacking the risks associated with DeFi. Things like admin key hacks, where you can go off and mint the shit out of things before anybody knows and then drain liquidity. We're trying to study what you've got for a systemic risk within the pool. So because right now, somebody like Aave, there's a few addresses in there that hold 95%, 85% of the whole token. Like that's, I wouldn't want to trade against them. It's basically trading against the house, right? Because that token's held in there. So I think it's got to evolve a lot. We need to see some decentralization occur on these DeFi platforms before anybody's going to get comfortable. But the other thing I can say is we've talked to the head of every global bank's foreign exchange trading desk, which is where they will want to trade crypto out of, and they aren't even ready to trade Bitcoin, much less DeFi. So the first institutions that are coming in are the tier 1 hedge funds. They feel like this is candy from the baby that they can just start, taking in and finding the alpha. But what we try and do is go through the risks involved with things, figure out what the on-chain problem things that we have can help them solve that risk so that they can engage in the platform. And then, last thing on DeFi that's a problem is the non-custodial wallet conditions that go on there. So what somebody like Goldman Sachs is trying to do is they would, in order for them to participate with an address that's trading on a DeFi protocol, they would actually need it to go through an AML KYC process. So they'd go to somebody like Coinbase and basically say, I have this address, is it whitelisted on your exchange, even though it's participating in this DeFi protocol. So there's a lot of stuff that still needs to get wound out of that before we're going to see a lot of money come into DeFi. Right now, DeFi is all of us crypto whales kind of trading shit back and forth. And the last thing on DeFi, I alluded to it earlier. I kind of believe in sovereign identity, that I should control my identity, and Google shouldn't know that I'm here tonight talking to you all and whatever the hell they're listening to on here. And I think decentralized ecosystems do that for me. But so what I would prefer to do with my wealth that I've generated in crypto is, if I have some cause that I'd like to put my wealth into, I'd like DeFi to solve that. So, if I want a 6% yield and what I want to support this week is water resources in Central Africa, and there's a smart contract out there that would do that, I would like the ability from a smart contract from my identity and wallet to go find that in a decentralized blockchain, deploy into their smart contract, and just start paying me my yield, and those people can use that resource to do something else. Right now, we're just slopping money back and forth between each other. We're really, we're having fun, but we're not solving any big problems at this point.
You guys clearly have tons of data analyze it really well, how come you don't trade yourself or like have a investment firm or maybe you do?
Yeah, no, I have this weird friend, maybe you guys probably know Arthur Hayes, who ran BitMEX. He's now a fugitive from the United States. So, you know, my exposure is through the company right now. You know, I've got enough exposure to the asset. My whole life is tied into this side of things. So, you know, I don't trade. I have some people who are in the organization. We kind of have it as, I mean, you know, you watch people on TV or whatever, kind of Novogratz or whoever, like there's no requirement that he's front running when he's getting on there. Elon, we saw that shit, nobody can come after him. So, you know, there's some nuance on it. I think when we started it, we kind of agreed not to have a hedge fund off the back of it. Yeah, it'll be a long ride back to the Cape tonight thinking about that question.
Kyle and Nate, do you guys want to plug your newsletter? It's like talk about what you guys have been publishing recently.
Yeah, sure. No, that'd be great. Yeah. So, like Tim mentioned, yeah. So I, myself, and my colleague, Naturally, every week produce a newsletter called Say the Network, which is just using our data, some of which you know you would look at what we are doing, and also the market data, which is in a separate newsletter called Say the Market. But yeah, so every week we touch on things happening in the ecosystem, generally focus on Bitcoin and Ethereum. For example, this past week, it comes out every Tuesday. This past week we touched on Bitcoin, the distribution of Bitcoin owners, so large holders. It's really interesting because it's kind of like honed into that of like, oh, there's so many like oh, it's such inequality of Bitcoin. Kind of look under the surface. A lot of these are like institutions holding on to that. So just kind of peeling away some of the myth and just using our data to really interesting stories out of it. So yeah, I would love for everyone to check us out. We're on Substack. It's you can just look up Coinmetrics, Say the Network.
I've actually been subscribed to like February.
Really? Thank you.
Every Thursday, we've started putting out State of the Market, which is more kind of about using a lot of our market data, futures, options, perpetuals and stuff there. So
Yeah.
that one doesn't quite have the following that. Nate
But there's
has.
interesting stuff there, and spot market share, and yes.
You're such a nice guy. You're crushing it. Forget it. Let them have it. You need to be up their game. David.
Can you just maybe like talk about like your company, like just just like culture there, like what it's like working at Coinmetrics,
Sure.
and maybe a little bit about kind of like the hiring process and what you guys are looking for.
Yeah, no, so we're again, because of most everybody, pretty much everybody who works there has kind of got a embrace of kind of that crypto ethos about what we're trying to do, trying to be open, solve things for, you know, I'm not quite that CEO who says I'm going to solve the world's problems. I'll probably get there on my trip to the mountains whenever I do, whatever that happens. But no, we're as I said at the beginning, we've got a set of values called open, pioneering, elucidating, and neutral. And on the kind of main thing that I focus on is how to allow people who work at the company to be pioneering and be. So we've created an enterprise business. We've started to solve the problems and we're creating revenue from that business. And many people on the team kind of jam on creative projects that they work on the blockchain side of things, or the network data side, or the market data side of things. I don't know if Kyle agrees, but we try and provide as much white space for people to work on cool ideas and help service them. We've got a lot in flight already that we've kind of worked on together as far as how we're working on it. But we've embraced a concept called that we've tagged, and so have others, employee first. So I have a very distributed team. We had it before COVID. I've worked for distributed teams and run them before. I think we have 9 engineers in Russia, 6 engineers in Serbia. We're in France. We've got 3 people in Nigeria. We've got some boring people in Minnesota, Arizona, West Coast. And then we got one guy trapped in Australia. I think he finally got out.
Oh, he did?
Well, he got out of lockdown, I know, but he's still in Australia. So, very much a employee first remote kind of culture that we work to build. We kind of focus really hard on that side of things. I'm the kind of the elder statesperson, which you might be able to tell, running the company, but I think the average age of the company is probably closer to 26. Nick Carter, my co-founder, I'm older than his father. He's 28. So, we're kind of really like to find interesting people who want to explore cool ideas. We kind of get behind a framework of where we're going, how we're driving, but where we pivot, where we work. We take a lot of the money that we are able to generate from investors and focus that on studying research, kind of creating interesting things that we think where's a lot of the risk stuff came out of there. So, we're really working hard to kind of create that creative open environment for people to come and work in. And I think the last thing I would say is, we have people across the globe. We started this year at 22 employees. I think this week we have 56. We're expecting that next year at 150 or 170. So we're hiring aggressive. We will go anywhere to find talent who's interested and wants to work with us and be part of the team that's open. I think the biggest challenge we have is how do you kind of create that culture in such an abstract kind of world? And COVID's definitely struggled. So we ran an offsite for the US North American based team here in Boston in July, with every intention to do the same thing with the European team in the fall, and then Delta kind of came along, but we'll try and revisit that. So the way that we've started to think about the company and how you work it is instead of having big anchor real estate fees somewhere, we do 4 times a year kind of get-togethers, 2 kind of regionally and then 2 with the team globally. And one is kind of a lot of work and stuff like that. And the other, hopefully in a good year, is in Cabo or Vietnam or someplace cool. But that's how we're trying to build the team. And we've been pretty successful. Now they're going to look at me like, where's Cabo? Like when did that happen? These are aspirational. The US event happened. We're not taking a lot of real estate because we're letting things be distributed, but that's how we're trying to create things. Thanks for that question. Yeah.
So since you guys are like directly like talking to institutions, assuming we have a bear market or just in a super cycle, do you think that institutional like attention will still be as I guess like as big as it is right now later on, like 2 years from now?
Yeah. So I think that we worry about what the regulators are going to say, and are they going to mess things up? Barring that, I think they're all coming in and they want to be in. They'd like to see some more infrastructure security, like Coinbase can't just decide to stop trading because there's too much volume. But I think they're coming in. I think, and they clearly, we survived bear markets for years in both markets. So I think they'll stay in. And the beauty of data companies is they're almost more valuable when the markets are down because people are searching for some answer that'll tell them this is going to get better. So from a business structure perspective, data businesses are wonderful in up and down markets. The thing that I worry about, if anything, is the capital funding and the VC funding if I need more. And right now that's so frothy that, that's a good situation. So what we're counting on is getting enough institutional adoption of the asset so that they're looking at our content and then kind of riding through any market after that.
Just to kind of like talk a little bit more about that, like coming from the institutional side of things, like institutions, like if you think about a big pension fund, there's like so much upfront research that goes into like them entering this asset class. So there's like 2-3 years of research that they're like dedicating to this space before they even like decide to go out and like buy some Bitcoin. So like when they are like kind of like given the okay to make the allocation, they're gonna make that allocation. And to them, it's not really that like, oh, am I buying like Bitcoin at 100K or am I buying Bitcoin at 80,000? For them, it's more like, I need to allocate 2% of my entire portfolio into this space. How am I going to do that over, like a 5-10 year horizon? So like, it's, and if it's a bear market, it's even better for them because it's like, they're going to buy it on the cheap.
So I met David in 2018 when he was working at Wellington. I've yet to sell Wellington 1. And they aren't buying, they aren't in the asset class. And this is like, it takes forever. Like there was another gentleman who worked with David at Wellington who left, and he came over to do some crypto work. And I won't go too long into this, but I used to be over in Kendall Square, and I was sitting with this guy at the Tate on 1 Broadway, and he was explaining to me how he was going to tell his wife he was leaving Wellington and coming into crypto. And I was like, oh, there's a scary fucking conversation. But in the room was, in the same coffee bar in Kendall Square in 2018, was Gary Gensler and Michael Casey talking about crypto and Bitcoin. I'm like, dude, like, it's okay. There's 4 of us in here talking about it. It's got to be a thing. But that guy, I said to this guy at the lunch, I said, when do you think Wellington will first hold physical Bitcoin? He said, they won't make their first trade until 2023. So we're still waiting. And then for us, and Luke helps me on the kind of growth and client engagement side of things. The amount of time it takes us to go through due diligence with these large regulated financial institutions, if they're going to go through it and we get them as clients, like it's going to be hard for anybody to get behind us. So for us, it's a huge business tailwind to suffer through the process and even get there. But between the amount of upfront work they do to figure out whether they're going to come in and how it's going to damage an image versus, all the onboarding we do, once they're here, we'll keep them. Our biggest advocate is still Abby Johnson at Fidelity, and yeah, exactly. Cool. Yeah.
I know you said you were gathering data around different risks of DeFi. Do you foresee eventually selling that to regulators or the government?
So we struggle with the government in general. We have a lot of philosophical issues because of our crypto roots. I don't know if this is the right answer to your question. There are players in the space who read on-chain addresses and they have with the forensic response, the Colonial Pipeline hack or whatever else is going on. I think what we would like to do is work with the regulators on getting them comfortable with the risks related to the DeFi protocols, not the characters within the DeFi. I think if they can understand what this thing is supposed to do and how they can see their data the way that they can see it, it'll get them far more comfortable. So not related to DeFi, but both the Fidelity ETF filing that's been with the SEC and the Bitwise ETF filing, both of those filings were supported by data that we provided because they wanted it collected by an independent entity. Because otherwise, the first couple of filings, they were like, oh, this could just be you kind of creating the data to fit your bias toward your argument. So what we see is providing kind of that supporting evidence of why it's comfortable for them to get in. And investing and trading in any of this is always going to have risks. It's just a matter of alerting people that this is a risk, and then they can get comfortable with it. But that's how I would see us working with regulators.